Starting off here, just real fast, giving you all a brief update. I started working on a new project for you all that I haven't decided when or not I'm going to release it to you all, whether or not I'm going to release it to you on little tidbit chunks, or if I'm going to give this to you all before I release it in bulk. But nonetheless, I started taking screenshots of all of my journals and all of my entries from the past 4 years. So going back to 2022 up until the most recent journal Friday of last week. And I sent over 100 screenshots of all my journal entries to AI to analyze. And then I prompted AI to take all of my journals over the past 4 years and condense them into a series of lessons, taking my personal quotes from my journal and putting them into this ebook for you all. So I'm working on that now. I just wanted to give you guys a little sneak preview. So far, I'm on slide, I think, 20. And each one goes into different chapters and covers different notes and different things that helped me along my strategy. And then also, it gives you a step-by-step guide and a rule book, play-by-play, on things to be mindful of and things to pay attention to as you're progressing through your trading journey. And things, of course, that are directly from me that I journaled over the past 4 years. So I've gone through it so far. I've read through it. I think that it's actually going to be very, very beneficial for a lot of you all in here. Give you all a lot more clarity in regards to the strategy, the approach, and some just key psychological reminders. Especially considering that I feel like the AI did a pretty damn good job directly quoting some of the things that I've written down over the years and then turning them into lessons. So that's something to look forward to. Massive week ahead. So we're going to start in today's video breakdown with the boring stuff. We're going to break down the fundamental backdrop. This report today is going to go into thorough detail on everything that we need to be mindful of and pay attention to in the coming days ahead. Doing first a recap of last week so everybody's on the same page with the market landscape and where we're currently at in the risk off sentiment. And then once we're done this detailistic fundamental report, it'll give us the if-then scenarios, which I have thoroughly typed out for you all, both risk on and risk off that we need to see. We will go into the charts. We'll take a look at, of course, all of the favorite crypto pairs that we personally analyze and have been covering for some time now in this community. So XRP, Canton, XLM. We'll take a look at metal, XPR, maybe even throw hype in there and just take a look at some dark pools and levels to be mindful of and pay attention to. And then I also want to leave you guys with an updated analysis on MNQ, what to be mindful of and what to pay attention to and levels that I'm looking at this week. Things that I'm paying attention to on setups, especially taking it level by level, where I will start to reverse my bias and flip bullish, and where I will look for sell continuations and so on and so forth at what levels. So we'll jump into that after we read thoroughly through the fundamental report. Starting off with a weekly recap from last week, both crypto and Nasdaq came under heavy selling pressure as investors shifted into a risk-off mindset driven by a combination of macroeconomic and geopolitical concerns. The biggest catalyst was a series of stronger than expected U.S. economic reports that pushed back expectations for Federal Reserve rate cuts and increased speculation that another rate hike may be needed later this year. I want to pause right there real fast so that way you all are engaged and not just falling asleep while I'm reading the most boring part of trading, which is the fundamental side of things. Make sure that you all are being attentive because once we get to the end of this, I would like to ask the question, what risk on catalysts would propel the market higher or lead to some formal recovery, and what catalysts would continue to weigh on market sentiment. And before I show you guys what I have written down, I would like for you all to curate me a list based off of making sure that you're paying attention to today's report. All right. So that way we're all actively engaged. All right. Where did I leave off? The biggest catalyst was a series of stronger than expected U.S. economic reports that pushed back on expectations for Federal Reserve rate cuts and increased speculation that another rate hike may be needed later this year. As rate hike expectations rose, Treasury yields moved higher and the U.S. dollar strengthened, creating a challenging environment for growth assets and cryptocurrencies. At the same time, inflationary concerns remained elevated as oil prices stayed firm following ongoing tensions in the Middle East. Markets grew increasingly concerned that conflict involving Iran, uncertainty surrounding the Strait of Hormuz, and continued clashes involving Iran-backed groups could keep energy prices elevated and slow progress on inflation. This combination of higher yields, a stronger dollar, sticky inflation, and geopolitical uncertainty led investors to reduce exposure to risk assets. The result was a broad de-risking across financial markets, with crypto shedding significant market capitalization and the Nasdaq pulling back from recent highs as traders moved capital towards safer assets and prepared for the possibility of tighter financial conditions in the coming months ahead. As we head into the upcoming week, market participants will remain heavily focused on two primary themes. That is, escalating geopolitical tensions involving the United States and Iran, and a series of critical inflationary reports that could shape expectations heading into the Federal Reserve Chair Kevin Warsh's first FOMC meeting, which is going to be the following week. Following last week's aggressive sell-off across both crypto and equities, investors remain cautious as the macro environment continues to lean risk off. The combination of geopolitical uncertainty, rising inflationary concerns, elevated treasury yields, and growing expectations of additional Fed Reserve rate hike, has created a difficult backdrop for risk assets. The geopolitical situation remains one of the largest variables influencing sentiment. Over the weekend, President Donald Trump stated that the U.S. has no plans to withdraw approximately 50,000 troops currently involved in the Iran conflict until there is what he described as a completion of the mission. His comments reinforced the view that the United States is not preparing for a rapid de-escalation and remains committed to maintaining a significant military presence in the region. So, hint, hint, I'm going to highlight this section. Meanwhile, tensions between Israel and Iran-backed Hezbollah intensified once again. The Israeli military launched strikes on Beirut for the first time since the latest ceasefire agreement was announced. After Hezbollah rocket fire was intercepted over northern Israel, the strikes targeted what Israel described as Hezbollah infrastructure, while Lebanese officials reported damage to residential buildings. Hezbollah's rejection of the recently negotiated ceasefire agreement highlights the ongoing fragility of diplomatic efforts and raises concerns that hostilities could continue to expand. Adding further uncertainty, U.S. Central Command confirmed that American forces intercepted Iranian drones threatening the Strait of Hormuz over the weekend. Iran responded by launching missiles towards U.S. allies, Iran and Kuwait, and increasing tensions throughout the Gulf region and placing additional strain on already fragile ceasefire negotiations. The Strait of Hormuz remains one of the most important economic variables for global markets. Of course, we know that the waterway serves as a critical choke point for global energy shipments, and commercial traffic remains significantly below normal levels following months of conflict and disruption. Negotiations between Washington and Tehran remain stalled, while Iranian officials continue discussing proposals that would place future access to the strait under Iranian administration, while imposing substantial transit fees on vessels using the route. The United States has maintained that the strait must be fully reopened without restrictions or fees. Hint, hint, I'm going to highlight that as well. While Iranian officials continue emphasizing Tehran's sovereignty over the region, as long as negotiations remain deadlocked, markets will continue to monitor the risk of supply disruptions, high energy prices, and additional inflationary pressures feeding through the global economy. From a market perspective, this is important because higher oil prices create a direct challenge for central banks. Rising energy costs can reignite inflationary pressures, making it more difficult for policymakers to justify interest rate cuts in the coming weeks and months ahead. This remains one of the primary reasons why investors have become increasingly concerned that the Fed Reserve may ultimately rate hike rather than cut rates. Hint, hint, I'll highlight that as well. Alongside geopolitical developments, inflation data will be the dominant driver of the economic calendar this week. The Consumer Price Index and Producer Price Index reports are likely to be the most important releases before next week's Federal Reserve meeting. Markets right now, this is extremely important. So, of course, I'm going to highlight this, what the markets are expecting, right? Because it's going to give us those if-then scenarios. If inflation comes out higher, if inflation comes out at market expectations, maybe the market's already priced in higher inflation, especially this past week with the sell-off, or if inflationary reports come out below what the market is expecting. So what is the market currently pricing in? Markets are currently expecting headline CPI to rise to 4.2% year over year compared to a previous reading with 3.8%, while the core CPI is projected to also increase to 0.5% month over month from a previous reading of, I believe, 0.4 or 0.3%. The producer inflation is also expected to remain elevated, with PPI forecasts sitting near 0.7%. These reports will provide investors with critical insight into whether inflationary pressures are beginning to stabilize or whether price growth is once again accelerating. For risk assets, the ideal scenario would be if inflation data coming in below expectations. A softer CPI or PPI reading would help ease concern that the Federal Reserve may need to raise interest rates again later this year. Lower inflation would likely reduce Treasury yields to an extent, weaken the US dollar, and provide support for both equities and cryptocurrencies, or at least some formal profit taking or support, considering the most recent sell off that we've seen. And I say profit taking from sellers, which will allow buy volume to resurface. Conversely, on the opposite side of the spectrum, if inflation exceeds expectations, market could further increase the probability of future rate hikes, which right now sit above a 70% probability, with a 96% probability that the Fed is going to hold interest rates at its next meeting. Higher inflation would likely push Treasury yields higher, strengthen the dollar, and increase pressure on speculative assets. Given last week's strong non-farm payroll report, the resilient labor market data, which was another upside inflationary surprise, would likely reinforce the hawkish narrative, which is currently dominating the markets. Investors will also monitor initial jobless claims, which come out on Thursday and are expected to remain around 225,000. While this report generally carries less weight than the CPI, signs of labor market softening, if this number comes out higher, right, showing that more people have filed for unemployment than expected, this could help reduce some of the concerns around the future Federal Reserve tightening. A weaker labor market would support the argument that economic activity is cooling and may lessen the need for additional rate hikes, albeit we saw an excessively strong NFP report last week. So one unemployment rate that comes out higher isn't going to be something that offsets the market expectations of Fed rate hike right now. We would need to see both cooling inflation and cooling in the labor market. Housing data will also be released through existing home sales figures. Forecasts currently point to an annualized pace of approximately 4.08 million units. While housing is not expected to be the primary market driver this week, any signs of weakness could further support the view that higher interest rates are beginning to impact economic activity. Beyond inflation and geopolitics, we have two additional risks that still remain firmly on our radar. The first is the possibility of a further intervention by Japanese authorities in currency markets. The Japanese yen still remains under pressure, and officials continue warning that they are prepared to take decisive action if volatility becomes excessive. Markets remain sensitive to the potential unwinding of the yen carry trade, a dynamic that has historically triggered a sharp risk-off move across global financial markets. Any significant carry trade liquidation would likely place additional sell pressure on equities and crypto and other risk assets, and it has yet to unfold at a very large scale yet. So this is still something that we need to be mindful of, and would be one of those catalysts where, if it unfolded, could create some form of flash crash liquidation event where we see crypto prices in one single candlestick wick down to extreme low prices and then wick right back up. All right, so just be mindful of that event if it were to unfold. The second area of focus will also, of course, be corporate earnings and the tech sector developments. As NASDAQ traders, we will be paying very close attention to earnings updates from Oracle this week, Adobe, GameStop, and we have Apple's Worldwide Developer Conference. Pause right there. If you guys are interested in watching that, it takes place tomorrow. The CYPRX researchers, of course, always coming in clutch, have found that conference. So if you come in here and you go to the crypto conference section, Break Free just shared that in the chat for you all to watch. They will be making AI announcements, which will, of course, feed into the AI narrative that has been rallying the stock market. So we will be paying very close attention to anything that might drive market optimism back into global stocks. Investors are particularly interested in Apple's AI strategy and whether management can demonstrate meaningful progress in the rapidly evolving artificial intelligence landscape. Any positive developments from major tech companies could stabilize sentiment within the growth sectors and provide support for broader equity markets. Looking ahead, the path to improving market sentiment is relatively straightforward. Investors need to see progress towards the US-Iran agreement, reduce tensions surrounding the Strait of Hormuz, lower than expected inflation readings would be preferred, stable treasury yields, and any sign that the Federal Reserve may not need to tighten monetary policy as currently priced in, as aggressive as currently priced in. Any combination of these developments would likely improve confidence and encourage capital flow back into riskier assets, or at least result in sellers taking more profit, which will result in some formal floor or some possible buy volume to come in. However, on the opposite side of the spectrum, the scenario for risk off still remains equally important. Escalating conflict in the Middle East, any disruption to energy markets, especially any higher than expected inflationary reports, rising treasury yields that strengthen the US dollar, renewed rate hike expectations. So if we see the rate hike expectations because of higher inflationary reports jump well above 70% and start to inch closer towards 80 to 90% of a rate hike this year, or any significant yen carry trade unwinds could all add further pressure to an already fragile market sentiment. For now, the environment remains highly headline driven. While markets have already experienced substantial selling pressure, we need to remain flexible and prepared for elevated volatility as geopolitical developments and inflation data continue to dictate the direction of risk sentiment heading into this next week's critical Federal Reserve meeting. All right. So that is the fundamental backdrop right now. First, taking a look at XRP. All right. And then we'll work our way down and we'll roll over to NASDAQ. So before we get into the TA real fast, somebody just give me a rundown. Give me 2 to 3 from your perspective, things that we need to see profit taking from sellers that will allow buy volume to come back into the market to possibly see buyers start to make some formal attempt to regain control over the most recent market sell pressure. Somebody give me one thing. We'll create a list of 3 and then I'll show you the list that I've created. What's one thing we need to see this week?
Lower interest rates.
The prospect that the market might not need to hike interest rates. Okay, we'll count that.
Peace
Somebody give
deals
me another.
going with Iran.
Perfect, right? And not just peaceful negotiations, right? Because remember, we could have one side say that peaceful negotiations are on the table, and then the other side say that that's false claims, that's not true, and tensions could continue. We need peaceful negotiations and de-escalations and confirmation from both sides. That would be the most favorable environment, right? An agreement, where both sides agree with the terms and conditions of whatever it is that they come to terms with. And then, of course, remember, we come back up here and I highlighted that troop scenario with Trump, where he's leaving the troops, the 50,000 troops active in the area. It would be even more beneficial if Trump said, you know what, we're good. We're going to withdraw these troops. The mission is complete. We do not need to, escalate the situation, and we can de-escalate our military presence in the region. All right. That would, of course, be extremely positive right now. So I highlighted that as something that we could see announced in the coming days ahead, that we need to be mindful of. All right. So good job. That's 2. So far, rate hike prospects decreasing. So right now the odds of a rate hike are sitting above 70%. We need to see those come back down below 70%, preferably below 50%. We need to see de-escalation in military negotiations, peace talks, some type of positive rhetoric from both sides of Iran and the United States, and preferably all other jurisdictions involved. All right. That's number 2. What's the third thing? Somebody give me just another.
Weak labor market data.
Sure, right? Cooling in the labor market data, right? Economic activity that does not support higher for longer interest rate environment and supports instead an ideology backdrop that the market or Fed may need to, ease monetary policy, or at least see data that allows for the Fed to not want to hike rates aggressively. All right. So here is my full list. It's roughly about 12 to 11 things. We need to see CPI come in below market expectations. That would be the preferred headline this week. If we see CPI and PPI surprise the market, which right now the market's expecting higher readings, if we see a surprise to the downside, that would be a catalyst that could substantially bring back risk sentiment. As markets are very fearful that inflation is about to spiral out of control, that would cool those expectations and those fears. We would at least like to see, I'll throw this in there, at market forecast, not seeing extremely elevated inflation higher than the market is expecting. So preferably below market expectations, but at market expected readings could at least we see, the market maybe already priced in high inflation with the sell-off last week. We'd like to see treasury yields move lower, particularly the 10-year yield. We'd like to obviously, of course, see that lead into dollar weakness. We'd like to see initial jobless claims rise modestly, signaling labor market cooling. Why is there that conflict right there where you can see initial jobless claims rising would lead into cooling labor market, right? Because if we see more people filing for unemployment claims, right, that means that the labor market is actually weakening. Vice versa, if less people are filing for unemployment claims, then that means that the labor market is, of course, strengthening, or that more people are in hiring positions or are finding work. Progress towards U.S. Iran agreement, positive headlines regarding the reopening of the Strait of Hormuz, reduced military activity between Israel, Iran, and Hezbollah, oil prices moving lower, preferably below $95 per barrel, no new threats to global energy supply. Apple, of course, Monday heading into Tuesday, delivering a strong AI strategy. Strong earnings reports that build confidence from Oracle and Adobe. No intervention or carry trade disruption from Japanese finance ministers. And markets would, of course, need to see in all of these factors reduced expectations for Fed rate hikes later this year. All right. So that is my list of what we would like to see for risk on sentiment this week. Now, again, remember, a rainbow scenario would be if we got all these things, but that is very unlikely. So we need to be mindful that intraday, right? So let's say, for example, Monday, Tuesday, we see none of these things, but then Wednesday, Thursday, we see one, two, three, or a couple of these factors. We have to be willing and ready to flip our bias, where if Monday, Tuesday are still risk off, Wednesday, Thursday could bring back risk on sentiment and play that bias accordingly intraday. All right. So just make sure that you all are monitoring these things. The risk off is just honest to God, flip this on its head and do the inverse. So CPI exceeding market expectations or coming out above what the market's currently expected would be super bad, right? That would be probably worst case scenario. Core inflation accelerating further, PPI rising above forecast, treasury yields continuing to climb, which would lead and feed into dollar strength. Markets would therefore increase odds of a Fed rate hike. We'd see, obviously, of course, hawkish Fed rhetoric from most Fed officials, especially markets would probably start to price that in heading into next week's FOMC. Any escalation between Israel and Hezbollah, any further U.S. military confrontations, any additional missiles or drone attacks in the Gulf region, any negative headlines surrounding the Strait of Hormuz or further disruptions that lead to further expectations that Hormuz is going to remain closed for a prolonged period of time, any Iran threats from additional restrictions or fees on shipping traffic, oil prices continuing to rise or maintain elevated levels above $94 or $95 per barrel, initial jobless claims coming in below the market expectation, reinforcing that labor market strength and supporting higher rate cuts, or excuse me, higher rates for a prolonged period of time. Any further discussion of Japanese yen interventions or yen intervention fears, or an actual yen intervention that leads to any unwinding of any yen carry trades and further strengthening in the yen. Weak earnings or any disappointing guidance from major tech companies like Apple, and any, obviously, of course, volatility in bonds, currency, or any energy markets. All right. So those are all things, catalysts that we need to be mindful of in the coming week ahead that could further put pressure on risk assets. With those scenarios in mind, okay, first, taking a look at XRP. Right now, the market across the board outside of Canton looks relatively the same. I'm paying very close attention to last week's low, which came in, of course, on Saturday, and last week's high, and all of the ranges in between. So as of right now, on the weekly time frame, the weekly high that we would need to break back above to see buyers fully regain control from the most recent sell volume that we've seen flood into digital assets like XRP is a sustainable break and hold above the $34 range. Until we break above $34, we are still in sell territory, meaning that all of these sellers here, if we see any buy volume come in at any of these levels, $1.18, sellers could defend. $1.27, sellers could defend. And even if we saw price come up into $1.34, sellers could formally defend. So right now, ideally, to reverse the bearish bias where we could see one of these scenarios play out, or even if we saw some profit taking result into some buy volume, we need to be mindful that these dark pools, $1.18, $1.27, and $1.34, if or not, whether or not sellers defend at these levels, would be ideally to see price break back above $1.34, and then we can reverse the bias from temporarily bearish to okay, now we're seeing buy volume regain control. and we can start to look for possible higher targets. So with that in mind, right now I'm being cognizant that if we cannot break above last week's high, which comes in at $1.34, these scenarios are likely the ones to play out. Now, I'm not saying the XRP's price is going to go lower, but we are likely going to see some defense thrown up at these levels if buyers cannot prevail and break sustainably above. The bullish scenario, where I will start to look for some buy scalps on XRP. I, of course, bought some XRP at the most recent dark pool at $1.11, which right now is slightly playing out in our favor as price is trading at $1.13. Nothing substantial. Is if we can start to hold support at $1.11, break above $1.18, and start to turn that into support, where we can start to anticipate the base at $1.11 holding for possible higher prices, or the base at $1.18 holding for possible higher prices. Again, not getting too excited until we see price above $1.34. So if we see these two scenarios play out, or we see a base hold at $1.11 or a break above $1.18 and the base that's created at that area hold to then see price trail higher, if we can break above $1.34, trap the sellers here after seeing buyers engulf them, see $1.34 turn into support, then we can start to anticipate some higher prices on XRP. Coming in above $1.34 would be a revisitation of $1.46 to $1.54 before we get overly excited on anything higher in terms of XRP's price. So level by level, these are going to be the levels right now that I'm paying very close attention to. Now, in a very extreme risk-off scenario, going back to the bearish plays, if we cannot see buyers break back above $1.34 and the inverse happens and we start to target last week's low, which comes in at about $1.05, and we see sentiment worsen in the risk-off scenario this week, and we see excessive sell pressure beneath $1.11, be prepared for a drop down to the next dark pool at 91 cents. That'll be our first initial bearish target where I will start to substantially dollar cost average into some XRP. Now, below 91 cents. Worst case scenario, this would probably be like that yen carry trade flash crash that I talked to you guys about, or some drastic scenario that takes the market excessively lower compared to where we're trading at today, which a lot of people probably won't catch this move because if it does happen, I feel like the dip is going to be bought up very quickly. So be prepared with this. Set alerts and alarms in case it happens. Buy limits if you are looking to dollar cost average in at these levels. So that way, if you're not at your computer, if something were to happen like this, your levels get triggered and you actually get entered into the market without you having to be present to facilitate market executions, right? But if we break below 91 cents, I'm still paying very close attention to a scenario where we do see a full-on retracement back down to the dark pool at the 68-cent range. And that would coexist with liquidating this low from October 2025. So those are the downside targets right now on XRP. We have targets to be mindful of before we get super excited on possible full-blown recovery. That comes in at $1.34. So right now we're going to play this level by level. All right. One thing that I will mention that I'm going to do, if XRP does drop down to 91 to 68 cents, considering that that will likely be some formal mass liquidation event in crypto, I will be lending out all of the money that I put into XRP at those levels. So at 91 cents, I plan to put about $10,000 into XRP. If we come down to 68 cents, I plan to double that and put about 20 grand into XRP. And I will be lending that out and I will be borrowing 40 to 50% against that on the loan protocol and buying more. Now, I don't know if I'm going to use that capital to buy more XRP or if I'm going to buy like Solana or if I'm going to buy more metal or buy something else that I can stake and earn in the Metallicus ecosystem. But if we see a liquidation event, I will use that opportunity to expand my liquidity. Because we see a liquidation event that drastically decreases your exposure to a liquidational event, that of course can improve your loan health over time. So with that being said, my strategy is going to be at 91 cents. If we see that come into fruition, buying 10 grand worth of XRP, lending that 10 grand out on the loan protocol, borrowing $4,000 to $5,000 against that, and buying more crypto with it to then, repeat the process and earn yield on that crypto that I'm purchasing. Same thing at 68 cents. I'll be lending out all of that 20 grand on XRP at 68 cents, borrowing against it in stable coins, swapping those stable coins over into some asset that I gain more upside exposure to. All right. I saw your hand up, Atoy. Just give me a second. Let's run through this and then we'll leave the floor open for questions at the very end. So don't forget your question. Canton real fast. All right, Canton. Wow, this passive seller, y'all, at 17 cents is not giving up. This is insane to watch in real time because I'm telling you all right now, after learning all the stuff about dark pools and learning about passive sellers and how they play defense, when this passive seller gets overran by buy volume, we are going to probably see a new all-time high on Canton because of all the sell volume and stop losses that sit at this level right now. I'm going to go out right and assume that if buyers can break above this, we're going to see a huge sell squeeze on Canton. Now, where the price is going to go, who knows? I'm not here to predict that. Most likely, of course, the first target is going to be the high at about 19 and a half cents. With that being said, right now, Canton traded up into that 17-cent threshold, which we have highlighted all the way since back at the beginning of February, where once we saw the aggressive seller break this level, buyers made some formal attempt to retest it. That aggressive seller became passive and started defending this level, and we can see clear as day that they have held Canton's price underneath of this level every single time buyers have become aggressive and pushed price up into this level. Now, I will say this. It looks to me as though right now, in terms of all the buy volume, that this most recent attempt to break the 17-cent threshold was the most predominant bullish attempt to break this level. As you can see here, from 13,916, we broke above the 14,801, and sellers were able to slightly defend and push price all the way back down to 13,916 before they made another attempt here. But you can see in terms of the sell volume and every single run up to test 17 cents, this is the first major attempt from the dark pool at the 13,916 that has no sell volume in it at all whatsoever that got from 13,916 up into 17 cents. So if Canton's price is going to break higher, this is most likely the bullish leg, in my opinion, that if it holds is going to take price above 17 cents. With that being said, right now, this is the most recent A to B move that we are currently in from the 13,916 up into 17 cents. So bullish scenario number one would be a retest of 13,916 base to see price explode higher. Second scenario would be a revisitation of the 14,801 to see buyers hold the base and break higher. And scenario number two would, of course, simply just be accumulation at the high, failure to break below or see sellers engulf buy volume, retest the EMAs, and start to attack the highs. We need to see buyers engulf the 18,194 before we get optimistic. And if we can see that, then we can start to target higher sell dark pools on Canton, which come in anywhere between 21 to 29 cents for our next areas of interest for possible intraday profit taking. Right. So that's something I'm paying very close attention to. I was able to have my orders executed. I had I had buy limits set at 14,801 and at 13,916, and they were all executed. So I was able to facilitate some really good positions on the most recent drop in Canton's price, which are, as of right now, all slightly in profit. I think I put about $2,000 in at each level. So really great to see the dark pools play out here to the freaking pip.